All right, good morning, everybody. Thanks for joining us. We'll go ahead and get started. People continue to drag in. That's the nature of these things, so we'll just jump on in. Thanks for joining us. Today's topic is what investors look for, an insider's guide to raising capital. I'll explain a little bit more about who your presenters are today. Who's talking to you right now? My name's Rob Belcher. I'm a VP at Lighter Capital. Lighter Capital is a Seattle-based national and Canada investment lender. We use a hybrid investment structure to lend to early stage and growth stage software and technology companies. We also use technology on our end to speed up and simplify the underwriting process. We use a structure called revenue-based finance, which I'll explain a little bit down the road if you're not familiar with it, but it's an innovative, entrepreneur-friendly structure that is a really good fit for today's software companies, particularly SaaS companies. I'm really excited to introduce my guest, Sirk. He has a ton of experience helping early stage companies on all sorts of fronts, really, and I'll let him provide his own introduction. Sirk?
Thanks, Rob, and good morning, good afternoon, everyone. We certainly appreciate you guys taking time to spend an hour with us. I am the Chief Operating Officer for Early Growth Financial Services, and you can see a little bit about our company here on this slide. But basically, we provide outsourced accounting and financial services for small and mid-sized companies. Having started here in Silicon Valley and in San Francisco, the bulk of our clients are in tech, and so we work with a lot of early stage tech companies, seed and Series A finance companies, and we basically provide our services on an hourly basis, so it gives the entrepreneur the flexibility to use us as needed and not anymore. We're big proponents of staying lean, and we help companies through all sorts of strategic as well as transactional accounting and financial work.
Great. And like I said, the topic today is talking about what as investors look for and how to prepare your company for investment. And so here's an outline of the agenda. These are the four main areas. I will say, sorry, so this actually brings up a great point. Please do feel free to type in any questions along the way, and we'll if they're relevant, we're more than happy to stop and answer questions. That's the best way. We want it to be collaborative, not just a lecture. If you want to dive into more detail on something, certainly, but there will be Q&A time at the end. But these are the four main things we'll be talking about today. And the first is reflecting on your business and knowing more about your business. Really understand, it's kind of the thing you don't think about. It is your business, but really understanding who you are, what your product is, and that kind of drives what possible investment is a good fit. And then projection. Sirk will really take over here and tell you more about projecting out your business, building all the various materials you need, what investors are looking for there, and best practices. And then preparation, pulling it all together. Again, a little bit of both what we look for, specifically here at Lighter Capital, what VCs look for, and things that Sirk can help, what he sees and what they end up often helping clients with. And then documentation is sort of nuts and bolts. We won't go into a whole lot of detail there, but it's a great list, a great resource of all the possible documents and materials you might need. So unless there's any questions at this point, we'll go ahead and jump in. This is a very detailed slide, a lot of questions here that actually make up a lot of what would be your executive summary or a lengthy elevator pitch. I'm not going to go through all of these, but as I mentioned during the intro just now, this is sort of the know thyself slide, right? Who are you? You think of it as your business. You kind of these are all in the back of your mind, and you know this stuff, but can you articulate it? Are you very clear on who your customer is? Are you only selling to Fortune 500 companies? Do you sell to consumers? Those are big differences, and there are VCs who only look at B2B enterprise investments. There are VCs who only look at consumer investments. So these are really important things. You don't want to be pitching your deal if it's a VC who has no interest in, they don't. It's not even their criteria. They can't even look at a deal like that. So something to keep in mind. Financials, again, making sure you know where you are, and like I said, customers is a big one. And then sales and market. Customer concentration. Who's your biggest customer? Is that a benefit or a risk? Potential acquirer, that kind of thing. And then team. VCs particularly look at team and are big into sort of what you guys have done in the past and where your gaps are, which is gaps can be a positive, right? Because you're using money to fill in gaps, so that's not a negative necessarily. Sirk, anything you would like to add on this one?
No, I think the first point that you made, which is really this is kind of the thought process that you should be going through, because this is the most of this information is going to be in your executive summary, and the executive summary is probably the first thing that an investor is going to see from you, and it should be very, very concise. It should be to the point. It should really allow someone in a 1 to 2 page document really understand your business, what you're trying to do, who you're going after, and who you really are. So this is a
Yeah,
great starting point.
yeah. I think my best conversations are with entrepreneurs who have this dialed in cold and walk me through it very succinctly. You know, we start the conversation. It's like, here's where we are on top line revenue, growth, bottom line, break even, burning cash. They're very honest about everything. They know where they stand with everything, their pricing model, who their target customer is, their sales pipeline. And we can just walk through it. And, I have my criteria, a VC will have their criteria, a Wells Fargo has their criteria. And so the more succinctly you can explain these things, the faster and easier for everyone the conversation goes. Wandering on about sort of the very detailed elements of the product, while yes, it's your baby and it's, you're very excited about what you're doing, and so are investors, obviously. But there's all of these other things are surrounding the product. So it's really important.
The one final thing that I would also just add to this is, as you're really reflecting about your business, is looking now and into the future, but think very, very closely about your competitors.
Yeah, that's a good one. That should actually be added to this slide. Thanks for mentioning that. That's really, really key. Okay, I think we spent a lot of time on this one, but it is the sort of nuts and bolts of starting out on thinking about your business. So we'll move on. Sirk, I'll let you start this one off. I think this is more in your wheelhouse.
Sure. Thanks, Rob. Yeah, and part of obviously fundraising is really kind of understanding how much money you're looking to raise, and how much money, what the money is going to be used for, right? And so, I say, you should look at two things. Obviously build up your financial model, build up your business case, understand your numbers really, really well. And then figure out, okay, I need to do two things with it, right? The final point, bullet point on this slide, I think is the most important, which is milestone financing. And we stress this because the valuation of your company is not linear and it's not a curve, right? It takes step functions, big step functions in valuation, and those step functions happen when increases in valuation happen when you hit milestones, whatever they may be, and they're different for every company, but it may be, product completion. It may be, a certain amount of revenue. It may be some number of eyeballs. Whatever the metrics are that are important to your company, as you hit those milestones, you're going to take big jumps in valuation. And so we always tell people that you should be targeting your fundraising so that you've got enough money to hit that next big milestone that's going to increase the valuation of your company, so that when you go for that next round, whether it's a Series A or B or C, that you'll get it at the valuation that you want, and you'll be able to give up less of your company to get that money. I always say to kind of couple that with a timing perspective as well. If you're going after institutional money, like VC money, then it takes pretty long effort, and so you want to be a little bit careful about not about raising enough so that you've got enough time to hit some of those milestones. This is where I would say that to the extent that you can take fundraising efforts and combine different types of fundraising, including revenue-based fundraising like lighter capital offers, that will just it really help you to manage your cash flow and allow you to hit the milestones that you're trying to hit.
Yeah, that's great, Sirk. The next slide actually will tie in really well with this, but I think this is really assessing what you need money for, and again, back to the first slide of who you are. The next slide, we'll talk a little bit about different options, but Sirk and his team have experience with all kinds of different VCs, as well as different types of financing structures and companies. So somebody like that can certainly provide some great advice on who to target and why and when. And again, the timing is really important, making sure you have plenty of runway. or it's rightly timed for a big contract or something like that. Those milestones are really critical. So that leads us into the different options, because where you are really indicates kind of who's available and at what cost and why. Oops, sorry, there's a rogue auto progression here. So, obviously if you're pre-revenue, your only real options are credit cards, your savings, maybe family and friends, and there are angels and incubators. Some VCs are doing some pre-revenue deals, but they're usually with very well-known teams that they've had experience with before, and it's their new thing. Sort of Jack Dorsey is a good example with Square. He started Twitter and then went on to Square, that kind of a thing. Most VCs actually get involved after there's quite a bit of traction, even $1 million or several million in revenue. Once you do have some traction, some revenue, revenue-based lending absolutely becomes an option. Our minimum threshold is about 15 or 20K in monthly revenue, and we lend against basically lend against your revenue and your revenue growth. We think that subscription, especially subscription, but any kind of recurring revenue or solid revenue stream is a form of collateral, and we provide entrepreneur-friendly, non-dilutive capital because you've got great customers and a great product and a great revenue stream. I can talk more about our model in a minute. Percent of all tech companies per year. So we always hear about it on TechCrunch, and we always hear about it on all the blogs and things, but it's still a very, very small part of the ecosystem. And so there are lots of other, a lot of angels, a lot of incubators. Look, we've done 55 deals in our 3-year history. So we do quite a few investments for a small shop, but we're growing. And then obviously as you grow, strategic investors and banks become an option. Banks basically won't invest in companies that are not profitable, and they often require a personal guarantee as well. Strategic investors, just to be clear, are companies like Microsoft or Salesforce or Oracle. They're industry companies that will make strategic investments in companies that have a great partnership or a potential acquisition. Anything you want to add to this one, Sirk?
No, I think that's a great description of basically the options that people have. The one thing that I will say is that and I think most people know this, but I always want to repeat it because it's so important. Is especially on the friends and family money, just be a little bit careful. Obviously, people say that this is one of the cheapest forms of capital. I actually say it's one of the most expensive, and because there is not just the financial considerations, but also the relationship considerations. We're going to be, we're going to live a long time. We're going to go through many opportunities. This probably isn't, if you're an entrepreneur, this probably isn't going to be your only one. There's going to be other opportunities out there, but you only have one set of family and friends, and so be really, really careful. Make sure that they explicitly understand that the investment that they're making they could lose 100% of their money. It should be understood explicitly again that that it's money that they should, if they lose 100% of it, then it's not going to impact them financially. So keep that in mind as you talk with family and friends.
Yeah, I'd say there's pros and cons. There's trade-offs to everything. Every investment is a compromise, including sort of do nothing. Right? In a sense, obviously we could talk through the pros and cons of all of these things, and most of them are fairly self-explanatory. Dilution with VCs, strategic investors tie you to one big company and may limit your ultimate opportunities, et cetera, et cetera. I think they're relatively self-explanatory. The do nothing is an interesting one because it may feel like there's no cost there, but there's actually quite a significant cost if you're missing out on opportunities because you don't have cash to hire, cash to grow faster. Anything that's sort of ROI positive, after you discount the cost of the capital, is something you should be investing in sort of the theoretical economics, right?
Absolutely.
But again, pros and cons of everything. So something to keep in mind. And again, we talk to companies all the time about different options, and obviously this is Sirk in early growth entire business. So definitely lean on them for help on sourcing these guys and who's the right fit for you and at what point. Okay, so quickly, just some of the pros and cons I thought I'd share with you just in case people are unfamiliar with revenue-based finance in particular. It is a relatively new instrument. On the financial and control side, we are much lighter than banks. We don't have any personal guarantees and very light financial covenants, no ratios or anything like that. There's no financial covenants really. There's covenants certainly, like you can't sell part of your business without telling us and that kind of thing, but no financial covenants you have to hold to. We fund companies that are burning cash all the time. On the added value side, VCs, this is where they shine. This is why you get a VC on board. It's somebody who has a lot of experience in your industry and can provide a lot of introductions and a lot of mentoring. Banks do relatively little of this, if not any, none. And we're somewhere in the middle. We have great partners like Early Growth Financial, and we have some other partners as well. We work closely with Salesforce.com, Microsoft BizSpark program, that kind of thing. So we love to introduce companies to partners as well as our portfolio companies and other opportunities that might come down the road, VCs and that kind of thing as well. Dilution, this is the downside to VC, obviously, significant dilution. Bank debt, this is the benefit. It's absolutely non-dilutive. Revenue-based finance is completely non-dilutive using our structure. This is actually somewhat out of date. We've actually moved away from a traditional warrant, which is common with sort of venture lending. We now no longer require a warrant. We do have a small upside, but it's a fee. It's a fixed amount as opposed to any type of participation in the sale of the business. Payment flexibility, venture capital is, people always think it's quote unquote free because there's no payments, except there's one really big payment at the end, right? But in terms of day-to-day flexibility, absolutely quite flexible. Bank debt is very inflexible. This is the big con with bank debt, and revenue-based finance is a great hybrid in between. Our structure is a royalty payment that drives your monthly payment up and down with revenue. So if you have a great month, you pay a little bit more. If you have a bad month, you have the flexibility there with a lower payment. So we're somewhere in the middle as a hybrid. And then speed, Sirk had a great point. He didn't even make the point about how it sort of takes the entrepreneur out of the business, the operations. But fundraising takes a lot of time. I just was talking to an entrepreneur who she took 9 months to close her last round of $750K. So a fair amount of money, but not even a huge amount. It took 9 months to finally close, and she told me that you can actually see in their performance, because it's such a small team, that's sales that aren't happening. So you can actually see the dip in performance while she was out fundraising. So keep that in mind. It's a very important part of the process, and it takes a lot of time and effort. Lighter capital, I mentioned, we use technology to speed up the process and get it done quickly. So that's one of our we're entrepreneurs too, and we want to get you back out there building your business, not having coffee meetings with investors.
And I'll add to that too, and I think those are really, really great points, Rob, especially about the time that it takes. I think it says here on venture capital, 3 to 6 months focused effort. I'd say 3 is really, really light. I don't see many deals getting done in 3 unless you're already established, or unless you're already a known name. Typically, we tell people, you've got to plan for 6 months, and you got to plan for 6 months of concentrated effort. It really should be almost considered a full-time job for one of the entrepreneurs, one of the co-founding team members. That should be basically their primary focus for 6 months. So think about that in terms of the level of effort and what that might mean to your business. I would say that for these types of things, it's typically not going to be an either or, right? It's not going to be either bank debt or revenue-based finance or venture capital. You're going to want to look at all the options, look at the pros and cons. A lot of times you're going to kind of want to piggyback one on top of another. Do revenue-based financing or do a venture capital round, and then couple that with a revenue-based financing model so that it does really increase your runway, and it allows you more flexibility and more time to hit those milestones that I keep on focusing on during these conversations.
Yeah, that's a really good point. We've actually seen a lot of companies using us as not sort of bridge capital, because they're not burning lots of cash. They might be burning a little bit, but not a ton. So the typical definition of bridge isn't accurate, but more boost capital.
Yep.
They're at a really good point. They're really interesting, and they want to go raise some money, and VCs are interested, but they're going to get killed on valuation because they're not quite at a really great growth rate or a really great revenue number. They're at an interesting one where VCs are interested, but they're going to get their significant chunk for the deal, right? So use us to hire a couple sales guys and really pour it on and hit that milestone that Sirk's talking about, and really bump your valuation. So when you go raise your VC round, you get a great valuation and actually probably a lot more money, a bigger round too. And it really, we've seen that play out, and it's really fascinating, and it's really helping companies grow. So the milestone stuff is really, it's real. It's really important. Okay, I think that's enough on this. Quickly, we've talked about revenue-based finance quite a bit. How does it work? As I mentioned, it's a loan, it's debt, it has monthly payments. The payment is a fixed % of your revenue. You can see the black bars here they move in concert with your revenue amount. It's a fixed %, so that doesn't change, but the payment changes, and then it just continues on until cumulative payments reach the principal plus interest, usually a 4 to 5 year period. It's meant to be long-term growth capital. This isn't short-term. It's not meant to be a year or 6 months. It's meant to be long-term growth and help you grow and hit those milestones like we talked about. We do 50K to 500K at any one time, and we can do multiple tranches over the life of the company. And as the company grows, it actually gets cheaper because there's more revenue, and we can base the royalty payments off of. Our royalty payments are usually are always in the single digits, never above 10%. Usually 2 to 6% is common, and we can lend up to 1/3 of the company's annualized runway at any time. So if a company's kind of on $1 million a year run rate, kind of 80K a month, we could lend up to 300K. Obviously, that's sort of the one big caveat to our model. We're not a VC. We don't take the big VC risk. We can't lend that company $5 million. That's not that's because we're not taking equity, so we don't have the upside there. But we provide that boost capital so that you can then be on a $5 million run rate and go raise that $5 million equity round at a great valuation.
We've done a lot of financial plans for companies who are looking at different sources of capital, and invariably it always comes down to this ends up being a very, very, for lack of a better word, cheap solution. Cheap from the standpoint of, okay, in the long run, as you're getting ready for an exit or after that exit, what will it have cost you to do this kind of a deal with lighter capital versus raising other funds? And this is almost always the cheapest, and it's very, very easy to model out. You'll be able to do it yourself. We can certainly help you if you want, or other firms can help you do it. But when you really look at the different options of financing, this is absolutely one of the best if you have a business model that would coincide with the way that lighter capital works.
Yeah, thanks, Sirk. That's right. Banks are cheap. They have a cheap cost of capital, and they require personal guarantees. So we're more expensive than a bank, but we're massively less expensive than equity. Again, people think equity is free, but it's the most expensive form of capital out there. So it's been a great fit for our companies. And I guess the other anecdote there is we've actually seen companies use our boost capital and come back for additional tranches. And now they're actually turning away VC term sheets because they know they only really need 300, 400, 500K at a time, hire a small team of salespeople, expand to another region, and they can just keep coming back and doing that. And they really, maybe down the road if they do international expansion or something, they'll raise 10 or 15 million. But at this point, there's no point. And so why have the dilution? Keep the equity to themselves at this point.
If you don't have to take VC money, don't take VC money. And if you can push out taking VC money until later, push it out until later. That's the way that we approach business decisions when it comes to financing, because it does change the entire dynamic in terms of equity ownership, control. I think Rob mentioned that in the previous slide. But those types of things really, really enable you to do what you want to be doing, and increase the valuation at the rate that's more favorable to you.
Yeah, sorry, I was flipping forward because I thought we have a short reading list, so I was going to see if that reading list was on this slide. It's on a later slide because we're kind of talking about some topics that are great. We have some great books for you guys to check out too as resources. But let's move on. Sirk, do you want to take this one also? I mean, this is where early growth really shines. This is why you would hire somebody like them, and we fully encourage it. It really helps, especially back to that point about taking the entrepreneur out of building the business. Somebody who's got expertise doing hundreds and hundreds of financings and building hundreds of companies can really help you pull this stuff together.
Sure. Sure. These are the things that you need to obviously have as you're going for a round of financing. I don't think you need all of these things if you're doing a revenue-based lending model. But if you are going out for outside money equity investment, then this is kind of what you're going to need. So we talked about the executive summary, but before even that, the elevator pitch, and this is the 30 to 60-second spiel that you have about your company that hopefully will grab the attention of the listener. Just because really all you're trying to do is you're trying to get them to say, oh, that sounds really, really interesting. I want to learn a little bit more about your company. And so it shouldn't just be a description of your product, but it should be more about a passionate statement about what you're trying to do to change the landscape of the space that you're in. The executive summary is a 1 to 2 pager. We talked about it. This should be an output of the reflections slide from earlier in the presentation, and it should give a little bit more detail, a little bit more description about the problem that you're trying to solve, the solution, the way that you're going about doing it, the team that you have in place, the key players on the team and what they've done and how it pertains to the problem that you're trying to solve, and obviously the market opportunity and competitive landscape. So if you can put all that into a 1 to 2 page document, then that's usually the first thing that that will go out to potential investors. The financial model and budget, we have to put that together because you need to understand the numbers. This is not going to go in your initial documentation that you send out. This is the information that you're going to have to back up all of the numbers that you're going to be talking about at some point during the due diligence. Product demo. This is getting to be more and more the meat of a presentation now, meat of a pitch. Yes, you're going to have a pitch deck, but more and more investors want to see the product in action, and so you should have that ready to go. You should try to have it localized if possible, but certainly over the internet. And if you don't have something like this, if you don't have it all together, I'd say you got to think about the timing, because nowadays it's just so easy and it takes such little effort to actually get a product out the door, to get a software product out the door, that talking to VCs or even angel investors without having that is a tough sled. And then finally the pitch deck, and we'll talk about kind of the what goes into your pitch deck on the next slide.
I'll jump back to financial model. I think, Sirk, you're totally right. The model itself and the budget is very much forward-looking and more for your purposes, for your purposes being the entrepreneur, as that's how you model out what the right financing structure is and what you're going to do with the money and everything, which is all sort of feeds into the pitch deck and feeds into these other things. The thing I'll mention is that's different than historical financials. If you are a business that's relatively small and you've been just running the business out of the bank account and the checking account, and you're looking to raise institutional capital, that's not going to cut it. You must have actual historical financial statements, a P&L and a balance sheet that you can share with someone. Otherwise, we have no idea what's going on with the business. Well, Aunt Sally gave me $200K. Well, if I don't see that anywhere, how do I know anything about that? It's really critical to have that stuff in financial statements. That's the language of business and the language of investment. So at that point it's time to get formal financials going when you're looking to talk to an institution. Let's keep moving on. Like you said, key slides in the pitch deck. Sirk?
Sure, absolutely. And actually, even before we get into that, I'll just do a very, very simple overview of kind of what the pitch deck should look like. 12 at the absolute max, and don't try to squeeze a lot of data or a lot of information onto the slides just to try to keep it to 8 to 10 or 12 slides. 24 to 30 font, right? Nothing less than 24 font. If an investor or potential investor opens up a pitch deck and sees a lot of small print, a lot of information, it's going to give them it's going to signal to them that you don't know your business enough to be able to concisely communicate the value proposition and spreadsheets. If you can replace words with a simple graphic, absolutely do that. Graphics are great. Product demos are great, as I mentioned before, and then probably the last couple of things that I'll mention is that you want to when you're actually kind of doing the pitch, do things like, let the best pitcher pitch, and know your numbers really, really well because they're going to ask. So, so those are kind of the high level, I guess, takeaways. But these are the things that you want to actually put into your slide deck. So who you are, what you're trying to do, the problem that you're trying to solve, the opportunity. And on opportunity, you want to kind of start from, we use these acronyms TAM, SAM, and SOM. So TAM is the total available market. You want to start with that. SAM is the serviceable market, and then the SOM is the serviceable obtainable market. And we usually, I think one of the books that we mentioned in here uses the comparison of sushi, right? The market for sushi on an annual basis may be $5 billion, but if you're opening up a sushi restaurant in your local town, then maybe the serviceable market is within a 3 to 5 mile radius, and that might only be $1 million. So understanding that dynamic and understanding the revenue opportunity is really, really important. How are you going to do it? How are you going to sell? What does it cost to obtain a customer? What is that lifetime value of that customer? Those are important key dynamics. How much advertising do you have to spend to get it? Those are very, very important. Competitive advantages in this. So I always say one of the slides you should be putting together is kind of like a table that where you start with your company and then you put in 4 or 5 or even more competitors, and then you do a checkoff of the benefits of yours or the things that you provide, and why it's better than all the competitors individually. And so it should be a table that obviously puts you in the best light. Do not be afraid of putting big competitors on that slide. And in fact, I even say, look, for a lot of internet and software companies, Salesforce.com is a potential competitor. Facebook is a potential competitor. Google is a potential competitor. And some entrepreneurs are reluctant to put those in there, and I say, why not? Go put it in there, because they're potential acquirers as well. And if one of the investment thesis is that, hey, listen, there's a market opportunity, it's not being filled now, someone's going to fill it, it's going to be us, and that's why I need the money right now from you guys, because I'm trying to hit this market before anyone else. That is absolutely a great investment thesis, and to the extent that a bigger player might do that in the future, is actually a good thing. And then the management team, I think, is probably the biggest one here. Pitch the company, not the product. Pitch your team and why you're the team that's going to be able to get this thing done and not somebody else. Because I guarantee you that there are other people who are doing or thinking about doing what you're doing, and it's very possible that the investors that you're talking to, are seeing other companies that are similar to yours. So it's not going to be about the product that you're developing, but it's about the team that is going to develop it. And finally, the funding requirements. You ask for money. Ask for this is how much money I need. Right now we're in a very, very advantageous environment for entrepreneurs. There's a lot of money that's being looked to invest, and so more and more entrepreneurs nowadays are actually able to put a little bit more, I guess, emphasis on valuation and how much money you need, and so be aggressive with it and ask for money.
Yeah, that's great. I would echo that the product is a very important piece. It's not the be all end all. It's that's what actually proves, if you have revenue, if you have customers, if you have renewals, that's what proves that the technology is working. And that will get somebody excited about looking into the technology. Don't lead off with the technology and the product. Lead off with all these other things that Sirk mentioned. What are the other benefits of the company? Because they're investing in the company, and the company is going to evolve the product and build new products. And so that's a piece of it. Especially early on when you're first building an MVP. It's easy to get excited about the product, but it's the company that the investor is investing in. And you need to focus on all the elements around it. Okay, let's move on.
I think this is just a simple one. You need to do a tops down and a bottoms up projection. The tops down kind of does that, TAM to SAM to SOM. which kind of gets you to the potential revenue that you're going after. And then once you have that revenue projected, then you have to do a bottoms-up projection to calculate the people that you need, the spending that's going to be required, and what you're trying to achieve. And you have to have those numbers cold. You have to be able to justify those numbers and the hiring that you're planning on doing and when you're planning on doing it. And hopefully all of that kind of adds up to the amount of cash you're looking to raise, over the next 18 months.
Okay, that's great. I'll talk to this one. The fundraising process is lengthy, but like we said, we at Lighter Capital try and use technology to speed things up. But it's treated as a sales process. It is a business development process. You need to think about it, as Sirk said. You need to come up with a list of potential investors in different products, even different scenarios, and know who you're targeting, because it actually looks poor for you as a company if you're talking to, like I said, a VC who doesn't have any interest in your industry or your solution. And determine where you are, how much you need, your funding round, and then finally build your value proposition. Sirk and his team at Early Growth can definitely help with that and help identify the right investors based on all these things we've talked about. And then last one is rely. This is Sirk's point. I'm gonna say it, and he can echo it. But rely on your ecosystem. There's no better cheerleader than your own network and your own cheerleaders and system around what you're working on. If you've got customers who you can leverage, or if you've got other investors, angels, and that kind of thing.
Muted.
That's where you really want to start there, because they're gonna provide the warmest intros for you. And then lastly, like I said before, we have a short reading list here. Some great books: The Art of Start, The Insider's Guide to Silicon Valley, and then Early Exits. These each have different points, but they're all really relevant to the small, fast-growing, early-stage software company. We highly recommend that you check them out. They're great sort of additional fast reads that you can read on your time. Sirk, any other points on this one?
No, I'd also even say that on the rely on the ecosystem, the one thing is everyone, right, should be part of that ecosystem. And if you're an early stage company, if you're a tech company, work with those that are going to be able to help you, not only from the service that they're actually providing, but what else can they do for you, right? Fundraising is a big thing. So for example, a lot of companies and a lot of partners might not know about, somebody like Lighter Capital. And so if you're kind of going to them, if you're working with an accounting firm, for example, that doesn't know that option, then they're not going to be able to make those kinds of recommendations to you. Same thing with, lawyers and bankers and everyone else, payroll service providers, HR service providers. All of these guys should be partners to you, not only for banking services and legal services, but also can they help make introductions to you when the time comes.
Yeah, great. Okay. I think that's so. Now we're at the point where it's just required documentation, and like I said, this is resources. I think we're kind of at about 45 minutes. Yeah. So we've been talking on for a long time, and I think it's a good point to pause and do questions. I'm going to slowly flip through the following slides. It's just a expansion of each of these bullets here, and it'll just provide a list of all the potential documents and materials that you might want to have handy. You should have handy for any type of diligence process. Some lenders and equity investors will dive deeper on intellectual property than others. Some will dive really deep on your material agreements, what kind of partnerships do you have or something. So you never know who's going to require what. And then again, lean on your service providers because this is what they do all day long. Lawyers will have copies of all your corporate documents, and then certainly people like Early Growth can help you with financials and all of your sort of business planning and executive summaries, things and all that stuff. So I'm going to flip through these as we go through questions. I think we've got quite a few, so we're excited to answer those. And then our contact info is the very last slide, which I'll end on, and you're more than happy to reach out to Sirk or I for additional questions.
Thanks, Rob. So yeah, keep the questions coming. We've got a few, so we'll try to get through them all, but keep them flowing in. So there's a couple of questions that really relate to if you're in a pre-revenue stage. The first is, really, is there any point talking to a VC if you are pre-revenue, but if you have contracts that will turn into revenue? Is the first question. And the second one is sort of really more that, you know, a lot of the different options, etc., that you talked about really kind of assumed a certain level of funding. So the question goes into, you know, what do you really need to do to get that initial traction, so those first dollars in the door?
I can answer that second question first, and then Sirk, maybe you can answer the first. That might be a good fit. I mean, I think what I've seen we've worked with hundreds and hundreds of companies, and so has Sirk. We funded 55, like I mentioned. Sell. I think this goes back to sort of the business planning and all that stuff. You know, the technology. Building technology for technology's sake is not the be-all, end-all. You still got to sell it. So if you're a technologist and you're not good on the phone or you're not good in person, find a partner, find a business partner, hire a sales guy, and sell. That's the answer. You've got to sell to call on your door. You know, it's really important to get out there, go to conferences, sponsor conferences, do some networking, that kind of thing, and sell, because and sales drive sales, right? You can do a blog post or a newsletter about a big new signed customer, get them to do a customer testimonial, and away you go. Sirk, do you want to talk a little bit about pre-revenue and raising money?
Sure, absolutely. So it's all about traction, and I'll echo Rob's words, which is you have to sell. Nowadays, most companies that are out there looking for VC money already have revenue, right? They've already got a product. It's already been up and running. They've already started selling it. If it's a SaaS business, I know a lot of you guys are in the SaaS business. You should already have customers, right? They should be paying for annual services, and without that, it's a little bit hard. To the extent that the product development is at the stage where you're not actually ready to sell it, but you already have clients or customers who are contracted to buy it, then I would absolutely say that that's traction, and you would want to obviously highlight, what you've done, what the contracts call for, and what the revenue will look like when those contracts are live. But I'm having a hard time kind of understanding, what type of contracts you might have to sell, or that you might have, without having a product that you're already servicing them. So you do what you can, but it's going to be tougher for you if you don't actually already have revenue going.
Okay, we got another good one.
Yeah. How do you value a startup? Investors are asking for a cap. So how do you set a cap price?
Yeah, so this question is about convertible debt, and so the question is basically, how do you value, what's the valuation of a company that has never had a valuation before and is relatively early, and then the follow-on is convertible notes and caps, and how do they work? Why don't you start up?
No, go ahead, Rob. No, go ahead, Rob.
Here's I've got two things to say. One is there's some great resources out there. Brad Feld has this, great blog, and he's kind of covered all the topics under the sun these days, but some of his older stuff has discussions on convertible notes. And so, you can go and research that stuff. The cap is basically if and when you do a formal equity round. So the convertible notes are a structure that came around a couple years ago as a way to basically avoid valuing a company, and it's debt that will convert at some point in the future when you do a formal VC round, right? Now, the trick is you have to do a VC round for that to make any sense at all. So if you never end up doing a VC round, these are sort of zombie instruments. And the second piece is they have a cap usually, which says, if it's 10 years down the road and the company is enormous, the angel investors that took the risk early on aren't going to get that same value at that point, because then they get diluted and their investment is sort of silly at that point. So they have a cap on it. And so the basic gist is the lower the cap, the better for the angels and the worse for the entrepreneurs. Now, where is that cap? They're all over the place right now. Sirk probably knows better than I do on what the average is, and he can talk to that in a second. So that's something to keep in mind. The last point about convertible notes is it's debt. That's my other point is it is technically debt. It's meant to be equity. Everyone who's doing the deal thinks it's equity, but then along comes a bank or a revenue-based lender, and we've got $300K worth of debt sitting on your balance sheet that we have to figure out. and we have to sort through it. So keep that in mind. It is debt. It sits on your balance sheet. It is not equity until it actually converts. If the point is to do equity, do equity. Convertible notes can be handy, but they're pretty complex if you aren't on the track to have a relatively short order VC round. The last thing I'll say about valuing an early stage company, I heard an interesting point a long time ago that if you're doing an A round, your company is worth $3 to $5 million. That's how you value a company. Is if you are doing an A round, then you're at a point where you're worth $3 to $5 million. They sort of define each other, if that makes any sense. Sirk, jump in with all your experiences on this one.
Sure. There's a lot of points to cover. Yeah, the 3 to 5. Maybe I'll just kind of start working backwards because that's the way my mind thinks. But yeah, the valuation thing. It's kind of it's different, and it's even different in different regions. Companies are worth more out here in the West Coast and in New York than they are in the middle of the country. Don't know why. I think it's more market supply and demand characteristics than anything else. Another way that we look at, there's several ways of valuing a company. One that a lot of entrepreneurs use, as well as angel and Series A investors would use, is something like a Burkus method, which basically says that you start putting some valuations on some things that you've already accomplished. So, for example, a good idea might be worth $500,000. A working prototype might be worth $500,000. A quality management team might be worth $500,000. Strategic relationships, product rollout, or initial sales. So you hit all these these milestones, and you say, okay, well, I've got all of these things. I've got a company that's worth $3 million, and I'm going to raise $1 million on top of that and give up 25% of my equity. So that's one way of doing it, and I think that there's at least some logic and reasoning behind it, and I think that that's pretty appropriate. But ultimately, valuation of a company comes down to supply and demand, right? There's only one of you. It depends on how much demand there is. If there's a lot of demand to invest in your company, you're going to get a very high valuation. If you are in a position where you're kind of scrambling, you're running out of money, you're a little bit desperate to get some money in the door, and the investors see that and they like that investment idea, then they might give you a term sheet where the valuation is very, very low. So there's a lot of factors at play there. Yeah, I think Rob's point about the convertible debt is absolutely accurate. And it is debt. It's a little bit easier to paper than equity. It'll take a little bit shorter time, and so if you have investors who want to invest in your company, if you're scrambling to get some money in the door, and they say, look, I don't want to value this company. We're not good at that, or we want you to hit a couple more milestones before a VC comes in and values the company. Then that can be an option for you. But it does limit you in terms of what you're able to do between that round and that next equity round of financing. So keep that in mind. It should be considered a short-term deal because if it goes out much longer than 6 months or so, 6 months to a year tops, then you're talking about it's really you just don't know what's going to happen, and that's when things like caps and discount rates on those convertible notes plays a big factor, and it could either hurt you or the investor. I forgot, was there something towards the front of that was asked that we didn't address?
I think we got it. I think that was.
No, I think we got that one.
Yeah, it was a good question.
Yeah. So here's another good question. When you're dealing with critical mass type solutions, take Tinder for example, and I guess those of you who don't know, it's a dating app. It takes capital or ridiculous luck to get the initial adoption that is the sales. So for an existing product without critical mass, what sort of funding options make sense, and how do you fund them?
Yeah, that's a great question. So I think the key there is it's a B2C company, right? It's a consumer app, right? So you're looking for traction and you're looking for that viral explosion. I thought the question did a great job of answering itself by saying either enormous amounts of capital or luck. So I think the key one there is some of those companies that have been successful have great teams with a lot of experiences and great relationships. They are hard companies to build without a lot of capital or luck. I think, like I said, the question sort of explained itself. I would say we've done relatively few consumer companies. We've got only 1 or 2 in our entire portfolio. we work almost exclusively with enterprise. There are tons of VCs out there that do consumer. It's a great space. There's a lot of money, but it's a lot harder to build a business from zero. Once you're established, consumer companies are very, very profitable and very large, but hard to build from scratch. Sirk, do you have any comments on that?
No, I think that's a perfect answer.
What's your slant at early growth? Do you guys work with a lot of consumer, or is it more enterprise, or?
Definitely more enterprise. Definitely more enterprise, but we're seeing quite a few app companies, right, that are targeted more towards consumers. And as we all know, it doesn't take a lot, right, to build an app. And so, we do see, because of the fact that we work with so many early stage companies, that we are seeing more and more of those. But I think that the bigger opportunities are there for the enterprise and B2B companies.
Sirk, I think this is a question for you. When you're thinking about putting your pitch documents together and your information for investors, is there a preference between top-down or bottom-up projections?
Absolutely. Absolutely, there is, and you kind of need to do both. On the revenue side, and it just kind of depends on where you are, right? So if you're relatively early and you don't have that hockey stick, you haven't hit that hockey stick yet, where you're seeing this explosion of revenue or traction, you probably have to do more of a tops down, right, in terms of a revenue projection. So again, we start with the TAM, the total available market, filter that down to a serviceable, obtainable market. And early on, if it's early stage, I say, hey, listen, focus your revenue on one specific niche, right, and build up a financial model, revenue model, tops down, that shows what the revenue projections could be, and have the investor actually think to themselves, oh, this entrepreneur is coming in and showing me what the revenue might be for this one little niche. Well, in the back of my mind, I'm thinking, wow, we could take this to this niche and the following niche, and have them almost like be able to project out and imagine a much bigger number than you're projecting. So that's one. If you already have traction, and if you've already seen kind of the trajectory of revenue, then then I would say kind of start doing a bottoms-up revenue projection. And so each has their place. Part of it is going to depend on the life stage that you're at, which one makes more sense. On the expense side, you have to do a bottoms-up. You can't do just kind of like across the board, hey, I'm going to use a percentage of revenue, or I'm going to use a percentage increase month over month or quarter over quarter. That just doesn't cut it. You've got to do a bottoms up. You have to look at the hiring, really put some thought into who you're going to hire, when you're going to hire them, and how many of those people you're going to need, and really build up an expense model bottoms up.
Great. Yeah, that was great. Thanks.
I'm sorry, just a final plug on some of these kinds of questions, especially when it comes to financial modeling or pitch deck. If you go to our website, or even to YouTube, and you do a search for early growth financial services, we've got a page with lots of other presentations that we put together on some of these topics, like either pitch deck essentials, or how to put together a financial plan, or finance and accounting for startups, those types of things. So take a look.
Rob, this one's sort of more specific to revenue-based financing. Can you talk a little bit more about how the pricing works? What's the difference?
Yeah, yeah, absolutely. So, yeah, I'll walk through more detail on how it works. I kind of, did the high level just to get the conversation started. We do 50K to 500K loans, like I said, up to a third of the company's run rate. The way it works is there's no term and there's no interest rate. So this, again, it's a hybrid, right? So it's a loan, it's like a bank, but the return and the way the payback works is more like a equity investor. You always hear angels and VCs talk about multiples, right? Angels and look for a 3 to 5x return in sort of a 2 to 5 year time period, and VCs are always talking about the 10x return is their target. So we do the same, except our multiple is 1x. So if we lend you 200K, you owe 400K total. And then we structure that royalty rate that drives your monthly payment small enough so that you'd pay that 400K, by best estimate, including growth and all that stuff, over about a 5-year period, like I said. So, it sounds like 100% interest. It is not 100% interest. It's over a 4 to 5 year period. And so, like I said, long-term growth capital. That's the structure, and that's the gist there. And then that success fee, I'll talk. That success fee is a fixed amount, usually 25 to 50% of the principal amount. So if we did a deal for 200K and you sold your business for $15 million, you would owe us an additional, 75 or 100K of sort of success in the success fee, but it's fixed. It doesn't participate no matter how big you sell the company for.
Okay, so a very quick question. Can you say what the blog was for convertible notes again?
Oh, I don't know the exact post, but there's a VC named Brad Feld who, this is back in 2002 and 3 when blogging was sort of just starting to become a thing, and he wrote a couple good blog posts on sort of VC term sheets, and I think he has one on convertible notes. I think Fred Wilson's another VC who posts a lot. He's got a good one on convertible notes. EGFS, like Sirk said, has a great resource center too, so check that out as well.
Yeah, if you just do a search, if you do a Google search, convertible note terms or something like that, you'll see so much information.
There's a lot written about them.
Yeah.
So we've got about a minute left. So Sirk and Rob, perhaps if you just give us the number one do and number one don't when you're trying to raise money.
Yeah, I think succinct. Be open and honest. I think this is something we didn't talk about is NDAs. We don't sign NDAs, and an NDA is meant to protect the IP of the company, not financials or sort of, sales and number of customers. I can't have a conversation with you if you won't share those numbers with me. So we don't sign NDAs, but, be succinct and open about the status of your company, and that helps move the conversation forward the best. And, that's what gets me excited about the business. And then sell.
Yeah, and yeah, well, and I'll jump on that and say that no potential investor is going to sign an NDA, so don't even bother, trying to ask, and then look at all your options, right? There are more options out there than you think about. There's the classic VC, but there's revenue-based lending. There's other types of financings that are available. You should look at those and think through the cost. As well as time that it takes. All those things should play a factor into your fundraising efforts. And then be dedicated. Be dedicated.
Yeah, that's right. Of course.
Dedication.
No one's going to want to invest in a company that the entrepreneur is looking to check out for sure. Be dedicated. Good. I want to thank Sirk for the time today. Wealth of knowledge there and experience. Like I said, they've helped hundreds and hundreds of companies. If you're looking to get some help with planning stuff and getting your financial house in order, I can't recommend anyone more highly. And if you are interested in fundraising, I'm happy to talk to you. Sirk could be a great resource too. Like I said, we talk about other options all the time if we're not a good fit. So happy to just have a conversation as well. Our contact info is here. Thanks, Sirk. Thank you, everyone, for your time. I think we had a little bit of interference in the middle there. Sorry about that. But we will make a recording that's either this one or we have a cleaner one we can post up that might be a better fit. So we'll make that available too.
Thanks, Rob, and thank you all for attending. And I can certainly attest to Rob and Lighter Capital and the value that they provide to our clients when it makes sense for us to introduce them to Lighter Capital. And if you're in that right space and the right time, then Lighter Capital is an absolutely fantastic option for funding.
All right, we'll send you guys links to the recording and the slides. We'll have those separate as well. So thanks again for the time. We'll talk to you soon.